Hi folks, this is Business 198. I wanted to discuss Chapter 4's Intercompany Transactions, specifically the merchandise sales, and this point here in exercise 4-1 is very relevant, so I thought we discuss this. And here we have Sorel, which is an 80% owned subsidiary of Pattern. The two affiliates have the following separate income statements for the year 2015 and 2016 as follows. And they're asking us to prepare consolidated income statements, including the distribution of income for both the controlling and the non-controlling interest for both the years. So let's get started with this one and see if we can help you with this problem. Although I've provided copious notes on this problem, and I noticed there were some errors, some small errors, I still thought it would be beneficial to kind of go through this together. And so we're going to take a look at 2015 in the beginning and start there. In 2015, both of the affiliates in this consolidated group had sales revenue of $250,000 and $500,000. So that's where we're going to start by adding the sales together. And that would be it if there weren't any intercompany sales, but there are. In fact, they tell us that during 2015, Sorel sold goods to Pattern for the first time in the amount of $120,000. So right off the bat, that's the sales that was made between the two affiliates, which of course is part of a consolidated group or one entity, and so this amount shouldn't really be part of the consolidated income statement. So we just go ahead and subtract the $120,000 in sales that are intercompany sales right off the bat, and then we move on to cost of goods sold, which is actually just a bit more involved. So for that purpose, I'm going to take a look at the right side of the screen here and kind of talk about what really occurred. So with cost of goods sold, we typically just want to add the 2015 for Sorel and 2015 for Pattern if there weren't any intercompany sales. And so we need to be cognizant of the fact that there are some intercompany sales, and so we'll deal with that in just a moment as well. They tell us that during 2015, Sorel sold goods to Pattern for the first time in the amount of $120,000. So this was an intercompany sale, which we have already subtracted earlier from the sales number, and now we need to subtract that sale from the intercompany, from the consolidated group, because it's an intercompany sale, and we're not allowed to recognize intercompany transactions in a consolidated group because they're considered just a transfer of goods within an affiliated group. Now, the easiest thing to do here is to just simply subtract the intercompany sale of $120,000, and that's the view the book takes as well. If you study the entries that are given to us in this chapter, they simply tell us to take the sales, whatever they are, and debit them, and for as far as elimination entries are concerned, and then do the same amount for cost of goods sold for $100,000. But why is that? Why are we reducing the cost of goods sold by crediting them for $100,000 when generally cost of goods sold are lower? This is actually a summary entry, and there is an expanded form that the book talks a little bit about, and I'm going to kind of explain that to you right now so that you can kind of see why we need to subtract $120,000 from here to get rid of the intercompany sales. So we still have a couple more things to do, because there is also some ending inventory has some of these sales, these inflated sales with markups within the ending inventory for Pattern. So we still have some things to do here for cost of goods sold, but let me explain why we're subtracting $120,000 right off the bat. Let's actually analyze what would have happened individually for these companies when they made these sales. For example, when Sorel sold some items to its parent company, it would have recorded some sales revenue and this would have been 120,000. That was the easy part, right? They tell us that it's $120,000. What would they have recorded as cost of goods sold? They would have followed the same gross profit margins that they have with other items. So we can take a look at Sorel in 2015 and what they've been doing. They have sales of 250,000. They have cost of goods sold of 150,000. And of course, the gross profit is the difference between the two, or $100,000. And so what we can do at this point is compare everything to the sales amount, which is always 100% of sales, of course, and then we want to divide cost of goods sold and gross profit that they've given us both by sales to determine that cost of goods sold is really 60% of the sales amount. So if the sales amount is 120,000, then they would have recorded 60% of that as cost of goods sold, and of course the inventory would have been the same amount. Now, what's interesting about this is that they already had this inventory on their balance sheet, right? How could you sell inventory unless you already have it, right? So they had inventory already on their balance sheet for $72,000, and then they sold it, right? I just wanted to kind of identify that it's not just coming out of air. It's actually something that, and this is a partial balance sheet, of course. So they had this inventory sitting there on their balance sheet, and then they sold it, and of course that becomes the cost of goods sold amount for them. That's the amount that represents cost of goods sold, and this is something that they would have had to record individually. From the purchaser's point of view, they would have simply picked up inventory at the amount they paid, which was of course the sales amount for Sorel. So they would have picked up the inventory at 120,000, and they would have chopped it up to accounts payable or something, or even cash, which is fine. Again, we're not concerned too much about balance sheet accounts at this point. We're concerned more about consolidated income statement, so we're going to stay focused on the income statement items, but still it is imperative for you to see that when consolidated, these two items will cancel themselves out in what we call the intercompany trade balances. Whatever the unpaid balances are, we simply just undo them by debiting accounts payable and crediting accounts receivables, and so that's going to be one of our first elimination entry, where we're going to simply get rid of the intercompany trade balances. In this case, we would debit accounts payable and credit accounts receivables for the 120,000. All right. And again, why are we doing all of this? We're doing this so we can kind of see the flow of costs and how Sorel recognized some additional markups, which is of course the difference between these two amounts, and they would have charged that to these folks, who then inflated their inventory costs. So there's some stuff in here that is intercompany gain, intercompany markup that shouldn't be there, and we're going to need to deal with that and get rid of it. But here I'm trying to explain to you why we're subtracting 120,000. So let me explain why we're doing that by going through this example completely. So then, in all of these problems, the book or textbook explains that we should assume that all inventory has been sold and whatever remains, we should go back and fix cost of goods sold with that. So at this point, we're just gonna go ahead and assume that the parent company eventually sold everything to an outside of the affiliate group, and what they don't give us this number, they don't give us this number explicitly, but it's not relevant at this point because this is a valid entry and it should remain on the consolidated group because this is a sale that was made to outside, right? They have this inventory and we're going to assume they sold it to outside of the affiliated group, and so all of this needs to be intact and it needs to make its way to the consolidated statements. So we actually don't really even care what that is. We just want to identify this as a step in what's going to happen with all this inventory. In fact, all of it's going to become cost of goods sold, 420,000, and they're going to of course reduce their inventory for the same amount. Remember, this was their cost, and so this is what they're going to record as a sale to an outside group. However, the problem here is that, is this the valid, or is this the correct cost of goods sold, or is this the correct cost of goods sold to the affiliated group? You see, this cost of goods sold comes from this number here, inventory, right? Inventory turns into cost of goods sold. So this cost of goods sold number is coming from this inventory number, which of course is inflated in value. So what I guess I'm trying to say is that this cost of goods sold is incorrect because this cost of goods sold has in it some sort of a markup, and we're not allowed to record intercompany markups or intercompany gains when we're dealing with all of this. So the simplest thing to do is to employ the IS, or the intercompany sales entry, which simply reduces our sales to within the group, which this amount here is 120,000. And also eliminates this bit here because we don't want this inflated number. We want this initial number that this company or this consolidated group purchased from someone outside of the group, right? They purchased this inventory from outside of the group and then they sold it within. So this is the correct cost of goods sold. This is in fact the cost of goods sold that they incurred when they eventually sell it for whatever amount, 150,000 or 200,000. Then that would have been fine, because that would have been cost of goods sold to the consolidated group, and this would have been the sales to folks outside the consolidated group. So this is what needs to remain. In other words, we can just get rid of the 120,000 by it's being debited here. We can go ahead and just credit it here. What's interesting about all of this is that the ARs would have eradicated the APs because of this IA entry, the intercompany trade balances. Right, so those would have reversed themselves because of this. And then we have gone ahead and gotten rid of this intercompany sale, which is a credit here, and by doing this intercompany sale IS entry, we've gotten rid of that one too. So we can chalk this up here as well to being eliminated as far as this entry goes. And then this particular bit was this portion here, which we also are going to eliminate, because a credit to cost of goods sold eradicates a debit to cost of goods sold. Well, what about this inventory? Well, this inventory was right here, a debit, and then when we consolidate all of these accounts together, a debit to inventory for 120,000 and a credit to inventory for 120,000 again is going to eliminate that. Right, so those are items all gone either just by consolidation and putting things together, or by these entries. And so at this point, then what remains? Well, please remember that this inventory that is being credited was this inventory that was on Sorrell's book to begin with. So this one is also out of here, right? And so this inventory is also out of there. So then what remains out of when we are done with all of these elimination entries and we're done netting all of these accounts together, the only thing that really remains is this AR balance that is owed from this sale that we made to the outside of the group, which is fine, and it needs to be part of that consolidated statement because this is a transaction that was conducted from with an outside of the group third party. So this sales is valid. It needs to make it its way onto the consolidated statement. So we haven't touched that. And this accounts receivable, of course, is something that is owed to us by outside of the group. And again, these amounts really don't matter because they are valid amounts. The only thing that we really needed to worry about was reducing this cost of goods sold, because now take a look at what we have. We have this cost of goods sold remaining in the consolidated statements, which is a correct cost of goods sold. This doesn't have any intercompany markup. So by recording this entry, we have ensured that the only cost of goods sold that remains is the portion that we incurred from dealing with outside sellers, and we purchased the 72,000 worth of inventory from them, and so this portion is valid, and then this portion is valid. So really, this 120,000 we have already eliminated up here, the minus 120,000, and this second part, the cost of goods sold, being credited for 120,000, that's what this negative 120,000 was. And I kind of had to go through this whole step to show you why we were subtracting not 72,000 but rather $120,000 in the elimination entries, because this is a valid cost of goods sold, and this is an intercompany cost of goods sold, which we just simply get rid of. There's a little bit more behind this, and you can take a look at the textbook. It kind of explains how the IS entry is actually an expanded form on page 209, where they typically talk about how the portion of sales for the intercompany sales, portion of that was the markup. So you can take a look at this right here a little bit more in detail. But what I just did, the elimination entry that I just did, the IS was this one right here on page 208, where the sales and cost of goods sold are the same amount. So far, we assume that, with good reason, we assume that all of the inventory that the parent company had purchased from its affiliate was sold. But that's not really what happened, actually. If we take a look at the question a little bit closely, it says that 30,000 in 2015, 30,000 of these sales, the intercompany sale of 120,000, 30,000 of these sales remained in patterns ending inventory. So what difference does that make? Well, if your ending inventory still has an inventory that had a markup which we cannot recognize, then the value of ending inventory is too high. And what was the markup? Again, the markup is always this 60% here. In other words, the markup, is 40% here. That's a gross profit. So 40% of this amount is in ending inventory, and again, we're not allowed to record any portion of intercompany markups. And so let's take a look at how this will impact cost of goods sold. Of course, we remember that beginning inventory plus purchases is equal to goods available for sale, and when we subtract then ending inventory, we arrive at cost of goods sold. So they tell us that this number is too high. It's too high by the $30,000 of intercompany sales, and the markup is specifically 40%, and that's this number here, the gross margin. Oops, there we go. And it doesn't want to calculate because it's all part of the text, so I'm going to go ahead and just put it in the side here, or 12,000. If the ending inventory is valued too highly, then that means the cost of goods sold, which has an inverse relationship here, is too low. It's too low by 12,000, in fact. So that's the second thing we need to worry about, is that cost of goods sold is too low, and so what we need to do is simply add that bit to our calculation here. So we'll go plus, and then we want that 12,000, so we'll just go 12,000. Once you do all of these items, you should arrive at the correct cost of goods sold number. And how do we fix this? This is given to us in the entry called EI. And if you take a look at the textbook, the EI entry ensures that we increase cost of goods sold with whatever intercompany profits were there, and then we decrease inventory because obviously the value of inventory is too high. Again, you can take a look at this entry, but basically, as far as cost of goods sold is concerned, we need to increase the cost of goods sold like we did here, and so that would have been the EI entry, and we simply understand that portion of that EI entry increases cost of goods sold, and we went ahead and added that bit right there. Alright, so now that we have figured out what the correct cost of goods sold is for the consolidated group, it is easy to actually come up with the gross profit, which is simply the difference between the two. With expenses, there isn't a lot going on, so I'm going to go ahead and just add up the expenses for both of these companies, which it seems like it's 165,000 if my math is correct, and then I'll just simply subtract that from the gross profit derived at the consolidated net income. Now, because the ending inventory is inflated, that means next year's beginning inventory is also inflated, and so we'll need to deal with that when we get down to 2016, and we'll deal with that in a bit. But for now, what you need to understand is that the ending inventory was just way too high, as because it had some intercompany markups in it, and so we just wanted to eliminate those markups by the steps we just already took. Now that we've done that and we have finished the cost of goods sold discussion, which was kind of a difficult discussion, but I wanted to make sure that I had that discussion with you and that I did my best to explain it. Let's go ahead and take a look at the income distribution schedules. We always start with the subsidiary because the subsidiary may have NCI and other things going on, and so we want to always start with the income distribution schedule for them. And for 2015, for Sorel, the internally generated income was 55,000, and it's given right here, so we don't have to worry much about that. We do know that, however, we had to deal with this intercompany profit that was inherent in the cost of goods sold, and when we did that, when we added cost of goods sold, what impact did that have? By the way, this 120,000 was an intercompany sale, so that had no impact necessarily on the net income of the subsidiary. But this 12,000 increase in cost of goods sold certainly reduces the net income, because see, this markup was already included in all of this, so we kind of need to be cognizant of that fact that there is a markup that we needed to eliminate from cost of goods sold, and so we can just go ahead and debit that here in the income distribution schedule, because if credits represent the sales, then the debits represent the expenses of cost of goods sold, which we've gone ahead and added that, so let's go ahead and subtract that amount here. And we do recognize that it's 80% owned subsidiaries, so that means 20% of it is owned by NCI, and then we just simply want to multiply the two to determine the updated NCI share according to our consolidated information here. We recognize that the parent company also had some internally generated income, which in this case was 70,000. So I'm just going to go ahead and input that here. There wasn't any situation with the parent selling anything or any of that stuff, so we don't have any adjustments here. And then we do go ahead and pick up the subsidiaries adjusted income, that's E49, and then out of that, the parent owns 80%. So 80% of that amount is the parent's amount, and I'm going to go ahead and calculate that, and then go ahead and add that to the internally generated income by the parent to arrive at the controlling shares income. Of course, if you were to add up this 104,400 and this 8,600, which has a total of 113. I know it's kind of hard to tell here because it's just off the screen. The sum total is 113,000, which is of course what we came up with on our schedule anyway. So that's just a double way of checking that. Alright, so we have to continue onwards, and so we're going to take a look at 2016, and again, the 2016 number is very much similar to what we did previously. The sales, we just go ahead and add across for 2016, which are 350 plus 540 for the consolidated group. And then we subtract the intercompany sales, and they tell us the intercompany sales were $150,000 in 2016. Sales to Pattern by Sorrel were $150,000. So I'm going to go ahead and just subtract that right away to arrive at $740,000. Again, for cost of goods sold, we're going to assume that everything that was sold between the affiliates was completely sold out, and then we'll adjust it accordingly to whatever was left behind. So just with the same logic as we did before, we're going to go ahead and get started by adding the cost of goods sold that are given to us here for 2016 for Sorrel are $210,000. Why this is not updating is beyond me. Oh, what's happening there? Okay, so $210,000, and 2016 cost of goods sold are $360,000, and we're going to eliminate the intercompany cost of goods sold, which again is the entirety of that $150,000 in sales. And again, the logic is and again, this is not going to be right because we still have some additional pieces we need to work on. But just so far, why are we subtracting 150,000 and not some lower amount? Because we're employing this logic again. All we want is the initial cost of goods sold, not the cost of goods sold that was amped up or marked up by the intercompany sales. So typically we delete that and we pick up the initial cost of goods sold. So the only way we can do that is we actually delete this updated cost of goods sold, which was 150,000. Having said that, let's take a look at what the impact would be on all of this if there were ending inventory from last year that was overinflated. And so let's talk about that a little bit more clearly. So again, we have a situation. I'm just going to copy that down here. We have a situation where previously the ending inventory was way too high, and so the ending inventory is way too high. Then that means the beginning inventory in 2016 is way too high. In fact, it is high by 12,000, the same amount that was previously left in ending inventory. Remember, this was given to us right here. 30,000 of these sales remain in Pattern's ending inventory. So this becomes 2016's beginning inventory. And so when beginning inventory is too high, then that means cost of goods sold is too high, because this is being added all along to arrive at cost of goods sold. In other words, it has a proportional relationship. So if this bit is too high, then cost of goods sold is too high. How do we fix that? We fix that by reducing cost of goods sold by the 12,000. And we're still not done, because they tell us that in 2016, there were intercompany sales of 150,000, of which 25,000 sales are still in Pattern's ending inventory. So again, we have to do the same analysis. where we can go ahead and just get rid of that because that was previous year's amount. This year we have a different situation. This year we have $25,000 in ending inventory, and a portion of that $25,000 has in it a markup, and the markup was of course the 40%. And so 40% of 25,000 in sales, and this amount was again too high, right? This was a markup between the intercompany sales, and it still hasn't been sold. This whole time we assumed everything was sold, but now we're adjusting it. So that's what we need to do. We need to adjust for this 10,000. That's too much in ending inventory. If the ending inventory is too high, then cost of goods sold is too little, and so we need to add to cost of goods sold this 10,000 bit. So I'm going to go ahead and do that. I'm going to go ahead and add $10,000 to cost of goods sold, and that'll be just enough to get to the right point that we need for cost of goods sold. And so again, we add up the individual sales reported, and then we assume all of it has been sold, so we eliminate all of the cost of goods sold, and then we deal with whatever was the situation with beginning inventory from the previous year, which was ending inventory previous year, and whatever happened at the end of this year, we need to account for that too. And again, I can simply, now that I've arrived at the correct answers, I can go ahead and just simply subtract that to determine the gross profit. And of course, we finally need to subtract all the expenses, which in this case seem a bit too hard to add in my head. So I'm just going to go ahead and add it up here, 125,000 plus 66,000. And then we arrive at a consolidated income by subtracting the two of 131,000. Again, we can do the income distribution schedule by starting with the subsidiaries' internally generated income, which in this case is 74,000. And what did we have to subtract from that insofar as cost of goods sold is concerned? And this time we recognize that the situation with the cost of goods sold was a bit more involved. So let's take a look at what happened with cost of goods sold here for the group. We recognized that from a previous year there was some built-in beginning inventory that was too high, and so we had to reduce cost of goods sold. And so that was, anytime you reduce cost of goods sold, that is that increases revenues for us. So I'm going to add 12,000 here in revenues, and I recognize that because of the ending inventory, there was too much cost of goods sold. So because I had to add $10,000 to cost of goods sold, that actually increases cost of goods sold by 10,000. By 10,000. And so I have to account for both of those impacts because they both impacted cost of goods sold, one positively, one negatively. And so anytime I increase cost of goods sold, that's detriment to the net income, and anytime I reduce cost of goods sold, that's actually a good thing for income. So we subtracted cost of goods sold 12,000. That means we had a benefit of 12,000 as far as income is concerned. So I can go ahead and just add up all three of these, add both of these items, and then subtract that amount to arrive at the adjusted income for the subsidiary. And of course 20% of it is owned by the NCI, so 20% of that amount goes to NCI's share. We also recognize that there was an internally generated income by the parent, which was in 2016 $55,000. It wasn't part of an affiliated group with someone else and didn't have any sales, so we don't have any issues here with cost of goods sold or any of the reductions. However, we do recognize that 80% of the subsidiary's income belongs to us, or rather their adjusted income. And so, I'm gonna go ahead and just add all of it here and then subtract the parents, then add the parents' share, excuse me. And so out of the 76,000 adjusted income by the subsidiary, 80% of it is owned by us. And so then when I add that portion to my internally generated income as a parent, I'll arrive at the controlling share. I can go ahead and add up these two amounts. Again, it says 131,000 down here. It's just a little bit outside my screen, so please take my word for it. It says 131,000, and of course that matches this amount, which was the consolidated net income. So this was not the easiest problem in the world, because we kind of had to go through this logic of explaining why we're getting rid of this intercompany cost of goods sold. And to understand more about this, you may want to read up on what these three entries are. The IA entry, in summary, gets rid of any intercompany trade balances. The IS entry gets rid of any intercompany merchandise sales, assuming that all of the sales were all of the inventory that was sold to outside affiliates, and then whatever wasn't sold, we go ahead and adjust it either in the ending inventory for the current year, or if it's a subsequent year, then we also need to worry about its impact on the beginning inventory next year, because the ending inventory this year is the same as beginning inventory next year. Alright, I hope this was helpful, because this was a difficult problem and I wanted to make sure that no one was left behind. Please reach out if you have any questions, of course, and I hope this really did help. Take care of yourselves.